All right, welcome to Real Estate Hustlers podcast. I'm your host, Josh Appelman. Today we are joined with Reid Bennett. Reid is the National Council Chair of Multifamily Properties at SVN and a principal at SVN Chicago Commercial. With over 16 years of experience and multiple awards in the industry, Reid, we appreciate you coming on the show today. If you could let the listeners know a little bit more about yourself.
Hey, Josh. Well, thanks for having me on. I appreciate it. I've been brokering multifamily buildings and complexes since 2001. So what is that? About 23 years. I'm based in Chicago, Illinois. I work predominantly in the Midwestern markets, a lot of secondary and tertiary markets around the Midwest. I also team up with a number of the members of my multifamily council around the country. And we work on deals in multiple states around the country with a lot of the boots on the ground that we have. So happy to connect with you and talk a little real estate, market rate, and affordable housing, whatever.
Yeah, for sure. Let's go back before. What got you into to brokerage and getting into multifamily?
Well, I graduated from the University of Iowa. One of my roommates at Iowa actually stayed back when all of my buddies did their victory lap, the fifth-year seniors, and he bought the house that they all lived in and ended up parlaying that into about 45 homes in Iowa City, ended up selling that, getting into apartment complexes. So he sent me the book that a lot of people have read that I see online, Rich Dad, Poor Dad, and it made me think a lot differently because I grew up in a family of teachers. And it was the whole go to school, get good grades, go to college, get a good secure job that everybody's finding out isn't secure anymore when they get fired or downsized. And so, real estate was one of the things that I could understand and grasp, and it made sense to me. It was a tangible asset. I started really reading everything I could about multifamily because I was just drawn to multifamily assets because I could understand, everybody needs a place to live. I need a place to live. I can buy a 3-flat, 4-flat, rent it out, live in the basement of the unit, rent out the other 3, and then have them pay for my mortgage and all my expenses. And so I actually I was running a personal training studio in the basement of a building down in the Loop in Chicago, and all my clients were either real estate brokers, real estate investors, or attorneys. And so I would spend an hour with them, and basically they would pay me for that hour, and all I would do is pick their brain about real estate and what's going on. And there was one of my clients who was a real estate broker, a multifamily broker, and he would come down and show me his checks. And a majority of the checks he would show me that he just received at a closing were more than I was making for the entire year of personal training, waking up at 5 a.m. and getting home at 9 p.m. And so I said, look, if this guy can do it, what am I doing this? And so that's when I got into it in 2001.
Got it. Very cool. Yeah, and the book that had to resonate with you, especially growing up with teachers.
Absolutely.
That's very cool. And then that's a really cool circle to be around. You're teaching them, you're training them, and then you're able to have a really cool. And I'm sure that circle helped you get to just notch up little levels of getting where you're at too. Just being around the right people.
Absolutely.
Very cool. Affordable housing. This is kind of the I've got a little bit of knowledge on affordable housing, but there's a lot to it, and you can get tangled up just by not reading the in between the lines correctly on these LURA contracts. Can you tell the audience what affordable housing is and what you can see, where you can see it going?
Well, there's a very wide spectrum of the definition of an affordable housing. It can run from what's called low-income housing tax credit properties, or Section 42, through different stages of project-based Section 8. So really starting with the low-income housing tax credits, or Section 42 properties, typically a majority of those, the housing built for the tenants that are living in those properties are what's called set-asides, and they're set aside for those that are making 60% or below the area median income, or the AMI. That's general. I mean, there's all different types of low-income housing tax credits, from family to elderly and those with disabilities. But just if we're just talking multifamily, the tax credit properties really are set aside in different markets for those, again, that are 60% or below the area median income. So think teachers, firefighters, the server at the restaurant that's in your community. A lot of those tenants might be in a high income district, and so this housing is built for that tenant base to preserve true affordable housing for those individuals. Then you go into which a lot of people know about are vouchers, Section 8 vouchers, where a low income family gets a voucher and they can go anywhere and get rent a unit from any landlord that accepts Section 8 vouchers. And then there's what's called a HAP contract, or that's a housing assistance payment, which is project based, which would mean the entire building or portions of that building are set aside for Section 8 tenants, where it stays with the project, it doesn't go with the tenant. And then you can cut up HAP contracts, again, elderly as well as family projects around the country. And it's in every single market. And getting back to the LIHTC, or the low-income housing tax credit property, the vast majority of the time you drive into an apartment complex, you would not have any clue whether or not that was a market rate apartment complex or a low-income housing tax credit. You still have a clubhouse, you still have, pools and tennis courts, workout facilities. It looks very similar, and it's very hard to tell unless you know that that's a LIHTC property.
Are you seeing properties being 100% LIHTC, or say 30% LIHTC, the rest is market rate? What are you seeing now?
No, the vast majority of the deals that we work are 100% low-income housing tax credits, but they could have different set-asides. So they might have, 80% of the units are set aside for 60% or below the area median income, and then a certain amount are set aside for 50%, and then 30%. And the thing about that is that you have to income qualify every single tenant. They have to meet a certain criteria of income in order to live in those units. You're not subsidizing them per se. It's just you're setting aside, and there are what's called maximum LIHTC rents that you're allowed to charge for that unit. So
tell us some strategies here, because as an investor, you're an investor.
Yeah.
There's got to be the upside. There's got to be the point. And if you're going in, you're buying these properties, you have a more accounting costs now because your books are being audited annually. You have to stay within all these restrictions. Your property management is probably costing more because you need, let's just say, a different level of skill to make sure the compliances are all intact. So what are some strategies to to make it make sense?
Well, and I guess, are you talking about acquiring existing LIHTC deals, or are you talking about building a new LIHTC property, or doing what's called an acquisition rehab to a LIHTC property?
Yeah, that's a good question, because there's strategies in all of them. And what have you found the most success in?
Well, the whole thing about why affordable housing developers get involved in either developing ground up or what's called an acquisition rehab, where you take an existing project or it could be a market rate asset, as long as it's been owned by 10 years or more by the current owner. You can buy that asset as an affordable housing developer and then try to go get receive the tax credits. Each state has a number of tax credits that are set aside per capita. And then you have all of these developers that submit for the tax credits in order to build these. So like BP Amoco or big corporations buy these tax credits, which allow for the developers to receive them through the state. And, it's a process that takes a significant amount of time and money for these affordable housing developers to go through in order to just qualify to receive those funds. So you can put a package together. It might cost them $60,000, $70,000 to submit the package, and they might not receive the credits. But if they do, there are developers fees and administrative fees that they receive, in order to put these deals together, because they're very, there's a lot of bureaucratic red tape they have to go through in order to, win these awards, and has to score well. So you do need to have, a significant incentive in order to provide the affordable housing. On the flip side, and we could talk about this as well, once a property is developed using these tax credits, there's a 30-year affordability component that you have to maintain the affordability for that project, and it's broken down typically into two 15-year periods: the initial period, and then the extended use period. And what we're seeing, especially in this market now, are, especially after the 15-year initial compliance period, we see market rate buyers buying those deals, buying those assets. And you can do, I guess there are three strategies you can use when you buy an existing low-income housing tax credit property. One is you can just simply continue to run it as is. And we've sold a number of light tech deals to market rate buyers. And if you're sitting in a market where the max light tech rents, this happens especially in secondary and tertiary markets, where the max light tech rents are sometimes even more than you can achieve in the market on a market rate unit. So the market rate buyers say, I don't care, I'll income qualify them, because all of the tenants that are in this particular market will likely qualify as 60% or below the area median income. And so I'm just going to run it as an apartment complex until the affordability expires. And then at that point, you can take it out of the program. You can just maintain the affordability of it on your own. Or
the burn off, is it 3 years, I think?
If you remove it from the program,
correct.
That's another strategy called the qualified contract. So if you're going to remove it, you have to, we could do a whole call on this process, but you have to put it out to the market, the affordable housing market, and at a price that really nobody is going to achieve. But if an affordable housing buyer picks it up, then they hit your target number, you're out. Otherwise, you have to freeze the rents while it goes through that process. It does probably take about 2 years to remove it out of that program. And then the third strategy would be to re-syndicate it, because especially after year 15, they're either 15 years old or they were rehabbed 15 years ago. And so, a lot of them qualify, especially if they're in what's called a qualified census tract, or, another scoring platform that they score well. You can receive tax credits and go through the project again and do a new tax credit strategy with that property. So there's just a multitude of ways. And that's what we find pretty exciting when we're working these deals is, when we offer a deal, like right now we have a 105 unit light tech deal, and we have buyers from all over the spectrum, from affordable housing to nonprofit to market rate groups, and they all look at it with a different execution strategy. And so we're able to maximize the value for the seller by saying, look, if you look at this particular kind of buyer that's going to go through this process again, it's going to be a lengthier process, and you don't know if you have a deal at the end, but they might be paying 15 or 20% more than a market rate buyer will pay. Sometimes it's the exact opposite. So,
how do you find alpha though? Like, is it just develop it? You don't bring on any investors because you're selling the tax credits for your equity. Is it the long game where 15 years you're going to get your multiple? Is it just is it off the cash flow?
When you're talking about from the initial onset of a light tech development, usually it's a developer's fee.
Okay.
They used to receive it up front. Majority of the deals that we're seeing now, they're deferring them. You have to defer the developer's fee in order to win the credits. So, depending on what happens to the property during that 15-year period, will determine whether or not you get your developer's fees. But the tax credits burn off after the first 10 and a half years. And
that's
then
kind of the incentive. You've got to have the carrot on the stick for developers to want to do affordable housing.
Absolutely.
So they're making them wait for that, and then that would deter a new developer from. I mean, you need cash now too. You got to pay for cash out that's going on expenses. So I guess, and plus you've got all of this cash out on just a what if it goes through.
Yeah,
and they're willing to take that gamble. So I guess they do enough due diligence up front that they've got a good feeling that this would be well suited space for this type of development, and these people at council would probably vote yes.
Yes. Yeah, and it's such a niche market that I know the attorneys, and there are particular law firms in each state that a majority of the awards go to their clients. There's one here in Illinois where my understanding is it's a little over 80% of the awards go to this particular law firm's client base.
And that's where the city kind of knows the quality of their paperwork too, and they know the process. They know they're going to be up and up with everything.
Sure.
And it goes back to who you know. Now, if you're buying a light tech, have you ran into any scenarios where they've overpaid for it and then the property goes into distress? And we know where it goes from there, but that can happen because you're caught in contracts. You can't raise rents. Like somebody's just ignorant to the program, and they can you tell us some experiences you've had on those fronts?
100%. So we just a few months ago we had a conversation with a group that's syndicating a low-income housing tax credit deal. They bought it. It was, I want to say it was in year 14. So I think they were assuming in year 15 it was out of the program. But then maybe they didn't. I don't want to make assumptions, but you still have the extended use period. They have to maintain the affordability. Their strategy was to go in and really re-tenant the entire property with Section 8 voucher tenants. Because the Section 8, let's take a number. So let's say that the max light tech for a 2-bedroom at this property was $1,100. Well, the Section 8 vouchers were $1,500. So what they were doing was, which, it was an interesting concept if it worked, but they were trying to re-tenant the whole thing with Section 8 vouchers. But you can't necessarily kick out a light tech tenant that's in there because that's what it was built for. It was built to provide the housing for the 60% or below the AMI. So unless you have a reason not to renew that tenant, it didn't work as fast as they thought. They thought there would just be like a high turnover with the property. Somebody would leave, a tenant would leave, and they would just turn it and put in a voucher. Well, they had been in the project for almost a year. And I said, okay, great. So let's look through your rent roll and show me how you can substantiate. I think it was like 144 unit project. And I said, all right, let's see the story that we're going to be telling the new buyer. Look, we've already proven this out with the fact that you've done this. How many have you done it with? They said 3. I said, you've done this with 3 in an entire year, and you're trying to sell it on the pro forma as if all of the 144 units were now project-based Section 8 vouchers at the 1,500. I said, it's not going to happen. They're like, well, we have a bridge loan that comes due next month. And it was predicated upon them, taking their business plan, through and having 50-60% of these done. So they were proving it up and then selling it on the back end. So I have seen that where that's going to be a problem for them.
Yeah, that's going to be a tough tough lesson learned. I have heard of a voucher overhang strategy. Are you familiar with that?
No, what's the voucher?
Voucher overhang, where you're basically using a Section 8 voucher to gain market rate rents. And I want to say that that's with existing tenants somehow, that they have them fill out applications and then you get income from one end and income from the other end. But again, that might show my ignorance to the program, because there's so many different nuances and do's and don'ts. But if you get caught up in the don'ts, then they can. I know that they can technically foreclose on the property too if you're re-tenanting.
Yeah. Well, the housing authority, in that location, you definitely have to meet that criteria. And the thing is, these deals are made up of GPs and LPs, right? And the LPs, the limited partners, are usually the big money partners and money players that have probably 98, 99% of the deal. And the GPs that are running the deal have, 0.0 something to 1% of the deal. And so, sometimes a lot of the Life Tech sales that we've sold and currently right now are in contract with are LP driven, because the LPs want out. Sometimes the GPs want to buy out the LPs, and that's just in their business plan. And then we've found that you have much more success when there's a GP that owns both the GP and the LP interests, and can make that determination, because more often than not, there's a significant difference in the value perspective that a GP and an LP have when you're sitting there trying to sell it, when they're both involved in the transaction. And that's one that you want to be real cautious of as a buyer, making sure you're not spinning your wheels trying to buy a GP driven sale when they don't have the authority to sell the property at that, at any price.
How did you start getting insights and gain knowledge on affordable housing? Because your mind can only expand so much.
Excuse me. I'm still learning. So I brought on my business partner in 2009, and 2009 was a time when, I was dabbling in affordable housing a little bit here and there. I had, I think, 55 or 56 affordable housing focused clients in my database that I was learning from. And there was one in particular, and he said, "Hey, look, if you're going to be talking to somebody that owns a Light Tech deal or a HAP deal, here's the laundry list of things that you need to ask that owner to give you. You can't just call up a Light Tech owner and say, 'Hey, can I get a rent roll and a trailing 12-month statement, and I'll give you a value of your property?' They're going to be like, this person doesn't have any clue what they're talking about. But if you ask them, 'Hey, can you send me the LURAs? Can you send me your audited financials for the last 2 years?' and then give the laundry list of things associated with either a HAP property or Light Tech property, they're going to say, all right, this person knows a little bit about it." So I knew enough to be dangerous in 2007, 8, 9. Was learning a little bit about it. We had, I had some close clients that were kind of towing the line of both. They would do both market rate and affordable, kind of walk me through it. I brought my business partner on, who is a CPA and really understood how to read the audited financials quickly. So I said, "Hey, look," and I don't know if you were involved in real estate in 2009 and 10, but nobody knew what to do during that time period, because everything, was going back to banks, and the deal volume was worse than it was, last year, the year before last. And so I said, "I don't even know what to tell you to do, but I have these 55 affordable housing owners and developers. Let's build this out, because in a downturn in a market, affordable housing kind of skyrockets, because the people that are on the cusp of market rate and affordable housing end up being pushed into an affordable housing property." So we took that from 55 or so to 955 developers, owners, and operators around the country that focus on this. And we started, that we created an acronym, Google Drive sheet of acronyms within affordable housing, because it goes on forever. And we'll be sitting there, 10 years ago, we were sitting there in a deal, and it's like the attorneys asked for this particular acronym, and I'm like, what the hell's that? He's like, I don't know. And we're looking it up, and so we add that to the acronym list that we've kept, because it's such a niched out market. We're still something new pops up on a different deal. We sold this deal in Lubbock, Texas one time that was a 99.99% controlling limited partnership interest on a 99-year land lease with a quasi-governmental agency that had to remain in the deal in order to get 100% real estate tax abatement. That deal was so complex that it took a couple years to get that done, but I learned every single one of these deals, I learned so much information from these. So 2009 is when we really started focusing on that. So,
I mean, that goes like find the business that has the biggest moat around it. And I mean, affordable housing has a huge moat because that's the barriers to entry, is that you need to be extremely savvy, knowing the nuances, knowing the in between the lines of the LURA contract and the just everything that the program puts out there, but you have to understand it too. And then one thing that reads this means another thing over here. It's just connecting the dots, and it takes a lot of brain power to even understand it to get in the game. And the properties that come online, they're like very, very attractive per unit price.
So of course, price per pound, everybody's all over those, and they call you, and we get offers from all over the place where it's like, here's my offer. And you can tell they have no clue what they're talking about, but they're saying, look, if the deals in this market are $160,000 a door and you're selling this one for $90,000 a door, I'll figure it out. But it's like, you don't understand that there are limited distributions, and that the capital stacks on some of these things with, forgivable debt or evaporating debt, it's extraordinary. And then there's city notes and, other things that that are underlying that, some of the buyers come on and they say, look, I'm going to include that in my capital stack and for the consideration. But if they're forgivable notes in 2 years, 3 years, 5 years, you really have to understand how you're going to view those, or if there are grants associated with these that are forgivable at the end of a certain period. It's just very, it's very niched, and the nuances are involved are pretty significant that you have to understand.
So for a listener that's interested in affordable housing, they don't know where to go, don't know how to start, how would you recommend that they start to learn about the programs and then learn enough to even make their first transaction? What path would you tell them to go?
Well, I would just start trying to gain as much knowledge from the specialists in the marketplace. And there's an accounting company called Novogradac, and the website for them is novoco.com. It's novoco.com. You go onto their website if you have a hard time sleeping at night, and they have every single niche within historic tax credits, low income housing tax credits, every program you can possibly imagine is sitting on their website. They're a fantastic resource. And I reach out to a number of them when I say, hey, how do you view this limited distribution on this property? Or when do you think this burns off? Or, to have some of those professionals on hand is but theirs is a fantastic resource. And that's one that I would start looking at immediately if you were thinking about this.
Novogradac, got it. Yeah, and I've visited that website a couple times, and it's got, you can get inept in just information overload.
Yeah.
But that's a great. What about any books? Do you recommend any books to get started? Or just in general?
In general, in real estate?
Yeah, just in general, just books that you would recommend.
There was I'm looking at my shelf here because I give a lot of the books away after I read them, but there's a book right now or not right now, but I read it recently, and it's called The Insider's Edge to Investing in Real Estate. Let me grab it real quick.
I'll write that down.
It's right here. Insider's Edge to Real Estate Investing. And it's by James Nelson, who's a broker and owner-operator in New York. And the way he wrote this book, I wish I would have had it when I started in 2001, because he lays out very succinctly in each chapter. And I mean, I'm like, oh, so this is how it should have been explained to me 20 years ago. This is how it should have been explained to me 10 years ago. It's a really fantastic book for people that are diving into it, and one that I would recommend to anybody.
Yeah, there's the blueprint, the path best taken. Those are the books that are just absolute gold. You can spend so much time trying to connect dots for sure.
Yeah.
Very cool. Reid, if somebody wants to reach out to you, learn more about yourself, your brokerage, work with you, how can they get a hold of you?
I mean, you can find me on LinkedIn. I try to be pretty visible there. You can also reach out to me on my cell number, which I can share with you right now or in the notes, whatever you prefer.
Whatever you want to do. It's this will go live, so whatever you want to do.
My cell number is 773-251-7342. Find me on, LinkedIn's the easiest, because in most search engines, when you type in somebody's name, that's the first thing that pops up.
Very cool. Reid, we truly appreciate all the nuggets today on affordable housing. Appreciate your time, and I certainly look forward to following you. Thank you.
All right, Josh. Thanks a lot.